the different types of controls. And this is an important part of auditing today. Internal control work has changed over the years. As I grew up in the profession, we didn't do a lot of it. We did all substantive testing. We went into the accounts, we analyzed them, we looked at documentation, and we reached our conclusion based upon that. We didn't do a lot with internal controls, but I think as time went on, and we switched more to a risk-based approach, an approach trying to reduce maybe some of the substantive testings, we've switched more to an internal control, at least approach in the beginning, the first part of an audit, to find out again what kind of controls the companies have in place. Are they implementing it properly? And as a result, can we now adjust the amount of substantive testing that we're going to do based upon our assessment of their internal controls? So in terms of understanding them, you have to understand there's different types of controls. There's three basically different types: preventative, detective, and corrective controls. And they give you this example quickly in the book. Preventative control, something like segregation of duties. In other words, you're doing things up front in order to effectively put in internal controls. Detection controls, things that we do later on to catch mistakes in the event that they happen. And corrective controls. In the event that they happen and we didn't catch them, ways to fix things. Now, internal controls, like I said, in most companies, there's sort of, people put them in explicitly, and sometimes they're sort of implicit. You start a company, you put people into positions, you start to do things, and you automatically start putting controls in, sort of naturally. There's different components to internal control. In fact, we bring these up, actually, they start getting talked about in financial accounting. We talk about the control environment, risk assessment, which again, we always come back to the same thing, risk assessment. It's all about what auditing is today, assessing risks. Accounting information systems and communication systems, control activities, and monitoring. Those are the 5 components of internal control. What is control environment? It's the whole way you run your business. It's the whole attitude that you bring to the table as management. It's the whole way you set things up day one and you continue to run your business. It sort of puts into effect as owners the way you expect the business to run. So you have to do certain things right from the get-go so that controls are maintained and monitored. The first is the ethical values and the integrity you bring to your business. It sounds sort of a given, but if you look back at Enron, one of our biggest catastrophes in U.S. corporate history, you were missing the first item on here. Top management had no integrity, had no problem misrepresenting numbers, had no problem entering into fraudulent transactions. As a result, right from the start, you had the wrong environment for the company. And these type of things transmit their way down right through the employees. When they see that this is the way management operates, well, that's the way they operate. So as management, you always start, if you want good controls, if you want the company to operate in a manner that is honest and ethical, well, you've got to do that. Obviously, commitment to competence. Hiring good employees. One of the best managers that I've ever seen in a business. This is a man today, easily, he retired 30 years ago, in his 40s. He's probably worth easily $250 million to $500 million today, this individual. Having retired 30 years ago. Ran a company that I thought was run as well as anybody had ever seen. And he told me something that he said there's absolutely nothing more important in running a business than the competence of your employees. And what he also told me, which I thought was sort of interesting, he said, you could never overpay for good employees, and you should never lose good employees as a result of money. He said the amount of money that you will absolutely save or make in the long run is more than compensate for overpaying people. She said, if you have somebody who's extremely good and competent at their job, don't ever lose them to money. I know a company today that when he tells me what he pays his top management people, these are people who aren't even college educated. These are people not college educated, running parts of his business that are making $250,000, $300,000 a year without college education, but are so good at their jobs that he doesn't mind in the marketplace overpaying them. They could never replace their jobs in a similar company for the same money. But long term, he's going to make money. So a commitment to competence and a commitment to having good people is an important part of this. Okay? Board of directors. Until, I don't know, 10, 15 years ago, you never saw a real board of directors other than in public companies. It was required by law they had a board of directors. I mean, all companies have to have a board of directors. But in a small company, you got two owners. They form the board. They're the board. So most times you saw real boards. You don't in public companies. But today you see them, and you saw them and you always see them, of course, in not-for-profits, because that's how you run a company. That's how you have a not-for-profit, the board of directors. But today, more so than ever before, since corporate governance has become so important, more and more private companies run themselves like public companies without such board of directors. One of the most successful ones I've ever seen was one of my clients, a company you all know, QuickCheck. You all see QuickCheck stores all around the state of New Jersey. It's a private company. It's owned by a family. It's run exactly like a public company with an outside board of directors. It's run clean. They have great financial information. They're on top of their operations. Their management knows that they report up to a board of directors and an audit committee, just like a public company. And it's one of the best run companies I've ever seen. And part of it is this, again, commitment to competence and this effect of using a board of directors and an audit committee to oversee certain parts of the operations. Along with integrity and ethical management philosophy and operating style, you have management that runs around like lunatics, screaming and yelling and doing stuff. But you have the type of management, the philosophy of running the company calmly and treating people right. What goes into controls? What's important? Does management have a philosophy? You walk into one company and all you see is chaos, papers, people running around like nuts. Then you walk into other companies and desks are clean and you can see them being run efficiently. And normally it's company B that's the profitable one or the more profitable one. Organizational structure. I have a client. We talk about internal controls. I have a client that sets up their organization structure like this. The owner, or we'll call it the president, this is their organization structure. Everybody reports to the president. Everybody reports to the president. Finance, marketing, sales, accounts receivable, everybody goes to the president. Grew from a small company into a very, very big company. Think you have good internal controls? You think this is a good organizational structure? You think this person is in a position that if there's problems, can oversee all the problems? One of the most successful companies I've ever seen. It also had a major fraud years ago that the owner missed. Because somebody, in one of these positions, sort of looked at this and said, they don't have time to look at everything I do. The system isn't set up in a way that a company that employs thousands of people, every position, every management position in the firm reports to one person. So organizational structure can have a lot to do with it. What if you've got the wrong people reporting to the wrong people? Human resources policies and procedures, very important. hiring the right people, having the right human resource people in place to monitor people, monitor people's performances, hire the right people, put in the right human resource practices, whether it has to do with reporting time, expenses, or whatever they have to do. So these are all part of what's called control environment factors. They add up to better or worse internal controls. Again, assignment of authority and responsibility. Making sure you have the right people in those positions and people checking on people regularly. When you're an auditor, again, your job, besides just checking the numbers, is of course to assess risk, okay? So again, auditors usually, like I said, your sense of smell, your sense of your business sense, okay? You can go into a company and do all the tests and all that you need to do. But what we do, again, the more experience you have, the better you get at this, is look at all the other factors that play into whether or not you have audit risk when you go out there. So you look at a bunch of other factors that come into play. Changes in regulatory or operating environment. Okay? As the business changes in terms of regulations, are there new laws? Is there something new in the industry? Okay? Is there something new in the economy? Always a factor. Well, for example, like I said, we upped our risk assessment. Any accounting firm did starting in 2008. The economy went to 10. Your risk as an auditor went up. You knew companies weren't going to be as successful. You knew there was going to be more pressure on them to perform, either for investors or lenders. You knew there was going to be problems. You knew there were going to be problems with their loan agreements. As a result, you knew you had more risk in your audit. Changes in personnel, always an issue. New CFO, new controller, changes in the bookkeeper, changes in the people doing things. Just naturally, that's going to give you more risk. Why did the other person leave? Were they fired? Was there issues in the way they were doing their work, which is going to cause you audit problems? Are there a lot of changes in personnel? So you always, when you go to a client, you find out, oh my God, they've got a new controller this year, are going to look at it as a client and in terms of doing an audit differently than the person maybe you've been dealing with for the last 5 years. Always an issue. They change systems on you. Always, because I've never seen a new accounting system go in anywhere, including where I work, that there are issues. Nothing ever changes. Nothing ever goes from an old system to a new system easily. It's never done the same. It's never seamless. There's always issues. You ever work in a company that changes systems on you? The first thing that happens, every employee hates it. It's just automatic. I'll be honest, I saw it in our place. We have a common billing system that our firm used. God, I can't remember. We were the largest company in the country using this system. We didn't have growing it, but we knew it. We were used to it. We did a merger with Cohen, and the decision was that the Resnick common billing system was a better system than the Cohen system. So we converted it. You don't know the difference. You only know what? You know a lead. Do you have any idea how much I hate Elite? Because I grew up with the old system. So every employee, I hate this, I hate. No one ever likes to changes. And as a result, you always have issues. You come as an auditor, and the client says, you know, I put in a new information system this year. First of all, you got to figure it out. It's going to be different than what you've audited in the past, and there's always issues. So your risk goes up. This always causes problem, rapid growth. Companies usually outgrow their systems if they grow too quickly. They outgrow their people. They outgrow their systems. They're so concentrating on the top line growing the company that sometimes controls go by the wayside, or controls that worked on a small scale don't work on a big scale. You see a company all of a sudden, this was fine when we had 3 or 4 people in the office. Now we got 20 people running around the office doing stuff. And new controls have to be implemented. New things have to be done. Things have to be done a different way. So rapid growth in an organization normally is a signal to auditors, step it up a bit. There's more risk. Changes in technology affecting production or information systems, of course. Change. What this is saying is, if you read through this, is what it's saying is when things are different, when you see change as an auditor for whatever reason, your risk profile goes up. New lines of business, again, all of this. Every line is the same thing with different words. Changes. Let's talk a little bit about segregation of duties. One of the first things we learn in the internal controls is the importance of segregation of duties between your employees. Very difficult to do in a small company. It's extremely important in a large company. And when you don't get it, this is when, again, you have an increased risk of fraud. The main definition of segregation of duties is to separate responsibilities of employees between two general categories: the record-keeping people and the custody of the asset people. As a result, you wouldn't have an employee making deposits, writing checks, in other words, the custody of the assets, the cash, the person responsible for the custody of the assets being the same person doing bank reconciliation and keeping the general ledger. To point back to an example in my own career of something that I could have done, and if I said it before, I apologize, when I kept the checkbook of this extremely rich individual. My job, I had the checkbook in my hands. I could have written checks, so I in effect had custody of the assets. I also did his bank reconciliations and did his general ledger. As a result, I was not only I could be writing the checks and recording the checks and doing the reconciliation. So I was on both sides of that. You don't have the people who keep track of the receivables, being the people who are approving the credit and getting the checks in. Once you do that, and you violate the segregation of duties rule, is when you have a problem. In one of my clients that we had a major fraud, it was the controller. You got the checks in the morning. You got the checks. You made the deposit. He kept the accounts receivable records. He did the bank rec. And he kept the general ledger. He did all those things. So all came under him. So he had custody of the cash accounts, he had custody of the receivable accounts, and he had custody of the record keeping over there. Hundreds of thousands of dollars later, when he got caught, it was all because of this violation. What are the objectives? When we put it in the accounting system, what are we trying to accomplish? It comes back to some of the major assertions in accounting. Trying to accomplish that we identify and record valid transactions. We want to put transactions into the proper classification. We want to be sure that we measure them properly. Not only that they're valid transactions and they're in the right account, but they're in for the right amounts. We need to determine that they're in the right time period. The check's being recorded the month that they occur. It sounds simple. It sounds like, of course, they're recorded then. Does it have to be? No. What if I didn't do it? If I record the checks whenever I feel like recording the checks? And then we want to make sure that, again, disclosure. So if you go back to the major assertions in accounting about, existence, valuation, things of that nature, which were covered in the previous chapter, again, the accounting system is, again, designed towards achieving those goals. Put in accounting systems, you put in internal controls, they do no good unless you actually use them. And you see this many times in companies where internal controls are put in place but not used. A camera is an internal control in a room. It doesn't work unless you turn it on. If I was an employee and you put cameras in the room, but they were never on, are there limitations on internal controls? Is there anything internal controls can't do? You put in great systems, great controls. Is there anything they can't do? Absolutely. People still make mistakes. People still make mistakes. I'm going to give you an example of internal control in an accounting firm. I should turn this on. Example. So controls are only as good as the people doing them, and mistakes happen. I mean, they just do. So you got to expect that in any business. There's not an accounting firm alive who hasn't made an error on something. It just, you hope it comes from that kind of an error more than your systems are poor. That you should have, that if you've done what you're supposed to. These cases, everybody did what they did, but they missed it. Okay. Compliance may deteriorate over time. Yeah, that happens too. People become complacent. They stop, it's a great idea, and as time goes on, we put in a new time and billing system, everybody's going, I'll put my time in. Things slow down over time. So there are limitations on internal control. So again, let's go back. This is being repetitive. I apologize to, she's not here. Again, overall approach to an audit. Again, this is 6 steps. You plan the audit. Again, we're talking about steps 2 to 4. An understanding of the client, its environment, internal control. This is key. You got to understand the account. This is how you do an audit today. You just don't go in and grab the books and start auditing. This is receivables and this is cash, and is it good numbers, bad numbers? It's all an understanding of the control environment and the client itself. Finding the risks. If you look at risk when you start an audit, you really have to do a lot more work or a lot less work when you really sit back as an intelligent, informed accountant and go, where are my risks here, okay? I think I'm going to tell you a bunch of Burger Kings, okay? We don't worry about inventory, okay? What inventories are going to be in a Burger King, okay? And whatever is in one is going to be relatively consistent, store to store to store. So if they have 30 Burger Kings, we're going to look at something like inventory and go, what's the risk? Okay, they got a few hamburgers and French fries, okay? Truly, so, seriously, how much inventory? Is this a risky area? Is one store going to have $1 million in inventory? No. We look at things like that and go, this is not a risky area. In fact, probably as a client, it's not a particularly risky client. When you look at something like that, you sit back and go, okay, in something like a Burger King, what would you look for? Well, they're going to have a lot of fixed assets. They're going to have a store unless they lease it. They have a lot of equipment. They don't have receivables unless you can get credit in Burger King, so you don't have AR. Seriously, you don't have AR. Cash is probably all sent up to a parent company of some sort, okay? It's probably pretty easy. What else do they have on the asset side? Think about it. What would you expect to find? Not much, right? On the other side, liability side. Vendors, wherever they buy their food from, okay? If they buy it through Burger King, you probably get some kind of a statement. So you look at a company like that and you go, at least at the store levels, the audits are pretty relatively simple. There's no risk. When you look at a Burger King, what do you want to do? You want to make sure the controls are in place, that people can't be selling food without it going through the register. So how would you check things like that? You look at volumes, you look at gross profits. There's an easy way to take a good look from a risk standpoint. Most Burger Kings, I would think, if you get 20 Burger Kings, the margins are going to be relatively similar. If all of a sudden you had a store with a really off margin, are they selling stuff without reporting it? They have costs going, no revenue. What people say, the guy standing at the register, and every time his family comes in, hand them, a sack of Whoppers, Seriously. So, that's how you as an auditor learn how to audit. You don't audit in a vacuum. You sit and you look. And like I said, and I told you, we had these jewelry stores in the Caribbean. It was high risk. We knew the valuations, the area of the world, the type of tourist travel that goes through there, variety of different laws in different countries, employees from all kinds of cultures and all over the place. Yeah, we looked at it, that's a high-risk business. Inventory that's very valuable and easily manipulated. So again, how does internal control help you? It helps you look for where you have potential misstatements. What you're going to do is design tests to test this, okay? Remember, what we're going to be doing in an audit is a combination, really, of control testing to see whether the controls are in place, and then factor that in, one of the risk factors, into what we're going to do with what we call substantive testing. And remember the general rule, the worse the controls, the more substantive testing you're going to do. You go into a company that has terrible internal controls, well, you're not going to rely on them anything. You go into a company that has great controls, and you see everything's in place, they're monitoring it, they're doing things properly, they're on top of things, you test it, and you see that they're doing them. The general rule of thumb is you're going to do less substantive testing. So, I mean, it's a pretty simple when you condense this chapter down to what we're talking about, the internal controls, okay? How do you figure out if the controls are any good or not? I mean, what is the procedure? Okay, we talk about them, are they good, are they bad? But how do you, as an auditor, even figure this out? You start really with something simple. You actually sit down with people. The narrative. Well, you may get to a narrative, where we're going to talk in a second, okay? But the steps in figuring out whether the controls are any good, and if they're good in some areas and bad in others, maybe they have terrific controls over payables, lousy controls over receivables, great controls over cash, lousy controls over inventory. And don't forget, we're not going to say that a company has great controls totally or bad controls. They might. But some companies are going to have good in some spots and bad in others. They're good at some things and, maybe not as good at other things. I've seen some companies that are absolutely terrific. That are dedicated to this. One of the best companies I've ever seen run, you happen to know. You wouldn't know them by their name. It's a privately held business out in Pennsylvania. Anybody ever heard of the Just Born Candy Company? Nobody ever heard of them, right?
There's a reason why.
What?
Must be a reason why.
Because you don't know who they are. But I guarantee you when I tell you what they make, you know who they are. Anybody ever have a peep or chickadees? A peep or a chickadees? Do the little marshmallows? Oh. You ever have Mike and Ike's hot tamales?
Yeah.
Golden Birch peanut chews?
Yeah.
You know those candies? Mike and Ike's hot tamales? Yeah. What? But we all know what a peep and chicken is, right? 80% of them. You want to know a fact? I think the number was 80%. Might be 2/3 or 80%. We learned this when we audited this company. 2/3 to 80% of their product winds up eventually in the garbage. Do you know how much that company's grown? Walk into a CVS today and go down the candy aisle. You don't just see the little yellow peeps anymore, okay? Now you see all kinds of them, okay? This is a privately owned company out of Bethlehem, Pennsylvania, right down the street from where Bethlehem Steel used to be. It's owned by a family. The reason it's called Just Born, it's owned by the Born family. But they use the term Just Born because in their advertising they talk about peeps and chicks being born. And you have to see how they're manufactured. This will make you feel good about it if you ever ate one of these things. They're actually good for up to a year. If you buy them this week for Easter, there's a potential that peep, that little marshmallow, was manufactured a year ago, and you would know this. They're frozen. You can't tell them. It's impossible. The other thing you know about these things is if you put them in a microwave, they explode. That's true. Put them in a microwave, they explode. One of the most wonderfully run, successful companies I've ever seen. Tremendous internal controls. The audit was always a set. It was never anything. It was the tone at the top, the control environment that they implemented over the years. As a result, they had a fantastic company. So again, you're going to sit with entity people and you're going to ask questions. Who does what? Well, just doing that doesn't help. That's a starting point, but that's certainly not an audit technique. It just gets you going. You got to go out and absolutely observe the application fees. You got to go see them do what you ask them what they do. If you're going to go through accounts payable to see how you're going to audit accounts payable, if you've got to do a lot of work or not, you got to watch and you've got to test this. You got to go through the documents. You got to trace some transactions. You actually walk through the process. How do you know how to do this? Because all accounting firms have, what do we have, Carlos? An internal control questionnaire. In other words, you don't go out there blind. Every accounting firm will design a questionnaire that you go out with. It's a very standardized questionnaire. It's tailored to your particular industry. You certainly wouldn't use the part about manufacturing in a company that doesn't make things. You went out to audit a law firm, you wouldn't go through the manufacturing section. But you have a guide, and all accounting firms have this because it becomes a standard procedure. So you're going to walk through you're going to ask how they do things, area by area. You're going to test revenue recognition. If you were to do Burger King, you would go out and say, actually look at a system. See how they record. How are sales recorded? Now you're going to say it's easy. You see how it's done in the register. Okay? But you walk through these things as part of your audit planning to see whether they're done and you actually test this. So again, we all have them. I don't think if you have, no matter what accounting firm you go to, they're going to have a standardized questionnaire, which has to be, again, tailored a little bit to fit the company that you're going to go audit. And then, Carlos, what are they doing? You're a manager. Used to be we handed out payroll checks, okay? Managers, the way a lot of companies used to do it. Big companies, they didn't go employee. Remember, this is back before automatic deposits, okay? So how do employees go, hey, you got a check. Well, somebody can walk around and hand out 1,000 checks in the company. They give it to the manager of the department. The manager of the department will go and hand out to all their employees checks and so on. All right? If we see weaknesses in the system, okay, that's when we up the amount of auditing because we find there could be an area. Now, we might not say in these cases it could be we might say this is a weakness, but not a material weakness, okay? You might say it's a small weakness. We tell manager we don't think there's a proper approval on firings and hirings. But we look at it and go, well, how much could there's a big company, how much mistake? Because again, we're coming back to financial ramifications.
Why does the client outsource this stuff? Like, what do you do?
We're going to outsource it?
Yeah, they have a lot of their.
We're going to talk about outsourcing, what we need to do. Because a lot of stuff is outsourced. What the requirement is in an audit, okay? In outsourcing, that's it here, okay? So again, part of it is not just filling in this internal control questionnaire, it's written narratives. Now, the good thing is in most companies, if you do this once, all you got to do is update it in future years. So you write up how accounts payable are done in your client. Next year you come back, you find nothing's changed. You test it to make sure that it's still in place. So it's the internal control work, which in all honesty can be a little bit monotonous. I'm not going to say it's the most exciting part of the work. Okay? It really is. It's sort of the foundation of an audit. But once you've sort of done it, and you've actually, the flow of transactions has been described, and you've done your flow charts, and there's one in the books, you normally just have to update them, okay? And you're going to walk through this. We had this walkthrough that we used to do in payroll. Back in the days we handed out checks. We had an audit procedure where we actually did what was called payroll pay. The week we were at the audit, we paid the checks to the employees. We walked through. This was an internal. And we wanted to see if there was an employee for every check that we handed out. This is a flow chart. Don't ask me about the different shapes. They actually mean something. They do. The ones that look like this are different. There are squares and this. I won't ask you the question, so you don't need to know. And if you do, when you'll find it out. So I don't. So again, we come back to this same concept of risks of material misstatement. This is what the whole thing is about. Okay. We keep coming back to the same concept, and that's why I, to some degree, keep talking about the redundancy here. And I apologize to some degree about that. Okay. But we're again going to come back to understanding the client, trying to figure out what's our chances of material misstatements, because again, our job is to opine on financial statements. And we've got to figure out if there's something's going to go wrong as a result of the internal controls, what is it that could go wrong and is immaterial? And what's the likelihood of it happening? Types of transactions, nature of transactions. How does this factor into your footprint? Well, most companies, 99% of what they do is sort of routine. They do the same thing all the time. They sell things, they buy things, they pay payroll, they pay rent, on and on and on. They do it day in, day out, okay? These are normally not the things you worry about too much. You're not really usually worried about routine transactions. Because most companies, if they're run efficiently, because these are the transactions that are 99% of the business, here's where they put in the strongest controls. You don't think Best Buy doesn't have great controls over their sales? They don't control, they may not worry about their reserve for bad debt controls as much as they worry about making sure that every product that they buy and every product that they sell is recorded properly. This is the lifeblood of their business. So what you find in most instances as an accountant is the general day-to-day transactions that you're accounting for are where the best controls are. It's in the other things that aren't every day, what they call non-routine transactions. Taking inventory. I don't know, to me taking inventory is sort of routine. It just doesn't happen every day. Calculating depreciation. Again, we're coming back to financial statement ramifications. They don't do these every day. So this is where you're a little bit more worried because it's not a day in, day out type of a thing. Inventory, though, is one of those things that you do spend a lot of time on most companies, depending on what kind of inventories they are. You really got to look at the type of company, the type of products they sell, and assessing your risk. Like I said, I had this large machine manufacturing company. I didn't worry about inventory. I didn't worry about it. We bought them in bulk. They were $1 million machines in some cases. They weren't walking out the back door. They were easy to identify. It wasn't an issue like it would be, and you could yourself look at any type of a company and say, is inventory going to be an issue here or is it not? Anyway, inventory is rarely a problem in an automobile dealership. What do you worry about? Somebody probably don't know this. Most automobile dealerships do not pay for their cars. They do what is called floor plans. They borrow the money from a bank to buy the cars. They don't want to lay out the millions and millions of dollars they need to do. They either floor plan it for to a bank or floor plan it through manufacturing. Okay? So maybe Lexus is doing it through Toyota. Okay? So on the books, you're going to have the following. You're going to have an asset called cars. You're going to have a liability called notes payable. Well, once you understand the automobile industry, and you understand that the controls in it are such that who's ever floor planning the automobiles requires a loan on an individual car basis. They don't just say, here's $5 million, go buy cars. They lend it car by car, okay? And every time a car is sold, that particular loan has to be paid off, okay? So if they bought a new Toyota for $24,000, the bank finances that $24,000, has a lien in effect against that car, and releases their lien when they're paid, okay? So when you buy a car, the whole transaction takes place.
Would they keep the car?
No, they don't keep the
They
car.
don't have the car there.
No, they've only lent the car. But anybody who loans under a floor plan arrangement is normally very careful of taking the inventory to make sure the cars they're loaning against still exist there at the dealership. That they didn't sell the car and forget to pay the loan off, okay? So normally you don't worry in an automobile dealership because you know the internal controls are normally in place through whoever they borrow the money from to make sure that the cars are there, okay? So it's not an issue particularly. It's not a valuation issue. Although you go count them, the likelihood that you're going to find a loan on a car and not find the car is virtually impossible, okay? So it's not real. Yes, they're valuable items, but they're not something when you learn the industry that you're really worried about risk so much, okay? You find a client, we're going to look just at the bottom of this slide. You find a company has high risks. What do you as an auditor do? What is your, you've gone through your internal controls, you've looked at the financial statements, you've assessed all the economy, what's going on in the industry, what's going on with the company, whatever changes have occurred this year. You have made your preliminary assessment. We have high risks here. You've looked at the loan agreements. I got to be careful with this company. It's a public company. What do? First thing you do is you probably up the level of the staff and work on the job. More often than not, you see in audits that went bad, you find that the staff assigned to the job were either underqualified to do the work or were poorly supervised. An accounting firm got too busy, they got spread too thin, and they sent staff out to do the job that weren't experienced enough to identify the problems, or the planning it as such that they didn't catch it, okay? And you find this regularly. This is how bad audits happen. You got the wrong staff on the job. They either don't understand the industry or the company, or they're underqualified by being inexperienced. Not enough supervision. This is why we worry so much during tax season when we get too busy. We have too much work in too short a period of time. Doing the same work over and over again every year. I saw it happen. Because the client admitted that, and I think I told you that story. The client said, I knew what you were going to audit, and I knew how you were going to audit. So I knew what to do. You've got to bring unpredictability into the audit process. Look at things you didn't look at last year. Do it differently. Expand your scope. Don't look at things they think you're going in. Look at things you don't think that they don't think you're going to. Bring somebody new on the job occasionally who has a different thought process. Okay? And when you really think you got a risk, you got to do more work. It's that simple. It's so straightforward. I got a problem this year. I think this company's in trouble. You as an auditor, besides all the other things you got to do, you just got to step it up and do more work. You got to look at accounts. This is when we talk about the assertions. We talked about assertions in the last chapter. The relevant assertions in accounting, the existence and occurrence, the rights and obligations, the completeness, the cutoff, the valuation, the presentation. You've got to look at each assertion in terms of determining where things can go wrong, okay? An inventory count is a perfect one. What can go wrong with an inventory count? Well, if we get the inventory count wrong, not only do we know the valuation of our balance sheet is going to be wrong, we're going to get a wrong cost of goods sold, because if you get a wrong inventory, you're going to get a wrong cost of goods sold. Impairment assertion, well, you're going to have a wrong valuation. So you got to look at the different assertions, and again, looking at risk there. What can go wrong? If this assertion isn't met, if I don't have completeness, if I can't determine that everything's being reported, what's my risks? We look. Cutoff is a perfect example. We have this company, again, it sells product with very, very, very thin margins. Very, very thin margins. They only make a little bit on each particular sale. When we look at the end of the year, we don't care about the cutoff so much. We're not really concerned with the cutoff. What if they report sales in the wrong period? Well, we look at this and we go, I did have a writing. losing everything today. With my
Bring your marker.
what is it?
Maybe colors.
Let's look at this situation. We look at this assertion and we go cut off on this number, okay? So the question is whether it should be an inventory or accounts receivable. Well, if I have an inventory item, and it's hypothetically $100, okay? And I'm selling it for $105, okay? My inventory, maybe my inventory should have been accounts receivable. So my inventory is overstated. My accounts receivable, I should have booked a sale, is understated. My profit's only understated by $5. We look at this particular item and we go, how often this company, they could blow a zillion sales here at the end of the year. The profit margin is so minimal on the sales, okay? So minimal on the sales that we don't think there can be a material misstatement as a result of total problem. Okay, so they missed some sales, okay? They missed some deals. They should have been in this period. The amount of income or the amount of additional income they might have reported or reported too early is so minimal in comparison to the company as a whole that we don't even do a sales total. We just don't find it to be material here. So again, we've got an assertion here of cutoff, but for this company, there's no risk here because there's no particular difference. Receivables and inventory are so close here. This is a company that makes it up on huge volumes. Now, if we saw $1 billion of sales on the last day of the year, we might say, okay, there's an unusual item. If we don't see anything in line, this is a company we find that the assertion at this level of there being a risk is relatively low. Again, test the controls. This is all about testing, okay? A lot of it's testing these controls. We're going to go in, we're going to see if they're in their monitoring, and we're going to determine whether they're actually doing it. They have an internal audit function. Is the internal audit function actually working? What are they doing? Is the work that they're producing good work? So we get back to the same, test of controls. Inquiry, this is summary. Inquiries, inspection, okay? We're going to ask questions, we're going to inspect the documents, we're going to observe what they do, and we're going to re-perform some of it. We're going to do some of it ourselves. And when we're all done, we're going to make an assessment, not only on the overall controls, but controls at different levels for different accounts. We may find, again, they're great on certain things and not so good on other things, so we're going to design our substantive tests around that. We're going to spend most of our time where they don't do such a good job. Now, if you're going to look at this thing, and I'm not going to ask you to, the one place I want you to sort of observe is you're going to come down here, and you're going to come through all the internal control things, and you get right here. This is the only thing I want you to observe. Is assessment based on the expectation that controls operate effectively? You get to the point where you say, are the controls effective? You make a decision that they're not. You guys don't have good internal controls. You have no segregation of duties. You're not taking care of your inventories. You're not reconciling your bank accounts properly. You don't perform any. The important thing you have to understand is you don't do any control testing. You don't waste your time control testing at that time. You go, your controls stink. I'm not going to use them for anything. I'm not going to rely on them for anything. You know what I'm going to do? I'm going to do all substantive tests. I'm going to up my substantive tests. I'm going to audit the heck out of your accounts, okay? I'm going to really go into depth in a lot of things. I'm not relying on anything that you do. Your controls are such that I can't rely on them. So I'm not even going to test them. I don't need to. I've already determined. So the thing I wanted you to get out of this is where you go from no to substantive testing. You just drop the whole control concept and go, your controls aren't any good. Now, like I said, this is the way we sort of used to do things. We didn't really rely on internal controls too much in the old days. Talk about a couple more things. Internal auditors. Most decent-sized companies have internal auditors, and they can be extremely helpful in the audit process. The fact that they exist is wonderful, but we use them, okay? One, you are allowed under GAS to use the work of internal auditors to help you. You can rely on them to reduce your testing. That's allowed. Once you examine what they do, and you in effect test their work, okay? So if internal auditors are doing the bank reconciliations every month, you can look and see them, and if you're satisfied with them, you can probably accept them. You would write up your assessment of why you accepted them, and why you can rely on them. So the competence and the work of internal auditors can be very important in terms of bringing down your costs and bringing down the amount of work that you as an auditor have to do. Two, can you actually use them on your job? Can you actually ask internal auditors to help you? Yeah. You can use them as part of your, as long as you're ultimately responsible for the work, that you're willing to sign off on the audit, you can actually use internal auditors to help you in performing procedures. They can do stuff for you. You just have to review what they do. And when does that ever come up? I'll give you a good example. You go to the client with the amount of the audit fee for this year. And the client says, what? How much? You tell him X. No, I don't want the bill to be that. What can I do to bring my audit fee down? You say it's easy. You supply us with some of the people. We'll supervise them. We'll review their work. We'll direct them and we'll tell them what we want done. But they're not our employees. I can reduce my costs if I use your employees for some work. Now, you can't just use anybody. You can't tell the controller, you're part of the audit people. But you can use the internal auditors. That's allowed. So we do that in instances where we're trying, again, to save money or save the client money and still make the job efficient and profitable. Who asked about service organizations? Did somebody in the back ask about this? Okay. A lot of companies outsource the work. Okay? The payroll is often an example. They can outsource a lot of things, right? How do you audit the payroll that your company's not necessarily doing? Okay? All the payroll records are maintained off-site by a third party. You want to audit payroll, but your company doesn't do the record keeping. So how do you audit that? Okay? Well, there's a certain procedures that are in place. Okay, when you have outsourced. One, you've got to contact them, especially if we're talking about something material. You can actually visit their location to see how they're doing it. But more importantly is number 3. Is obtaining a report from the service organization. And it's not a new name. It used to be called, I think, a SAS 70 report. You want to make sure that the internal controls in place at the service organization are such that the things you're reporting on are done accurately. So service organizations are required to get internal control reports performed so that their customers can get that. We have a client who performs certain services for some very, very, I'll give you an example. This company is in the business of employee, employees move.
Relocation.
Relocation, thank you. Employee relocation. The companies that they supply services to are some Fortune 500 companies. Certain of these Fortune 500 100 companies have told them they won't use them as a supplier unless they get from their auditor a SAS 70. It's got a new name. It's not a SAS 70 anymore. Something 1. It's a new name. I forget the number. But it's an internal control report. This company won't deal with them unless they know their internal controls are in place. And if they won't get the report, they won't use them as a vendor. This company fought doing the report business. It's very expensive. This could be doing an internal control report at these levels can cost easily $100,000 to $200,000 to do them properly under the rules that are now in place. They don't want to lose the customers who have required this. They said, I won't deal with you because I know your internal controls are in place. So in a lot of cases, what you do is you go out and get reports that say, hey, my payroll company has good internal controls, so I can rely on their record. Okay, does that answer your question? Okay. That was what, it was a type 1 and a type 2. It's changed, it used to be called a SAS 70 report. It's 2 different types of reports. This is actually a service that accounting firms now do, providing these type 1 and type 2 reports on the controls of service organizations. Now, we have a requirement as an auditor to supply an internal control report at the end of each job. You have to report to management, whether it's a public company or not, deficiencies in internal control. There's 3 levels that accountants have determined of deficiencies. There's not a very fine wall here between these levels. They're called less than significant, significant, and material weakness, and they define them in the book. Now they're important in that the importance of this is the requirement under gas in gas these days that you are required as an auditor to actually supply this report to your clients. Okay? It's an internal control report. It's part of your package at the end. Let me just give you the definitions. A significant deficiency is a deficiency in control over financial reporting that is less than severe than a material weakness, yet important enough to merit attention by those responsible for oversight of the company's financial reporting. So you find out that some of the shipping documents aren't being signed off properly by people. You find that purchase orders aren't all being approved properly. It's a significant deficiency, but it's not one that worries you to the point where the financial statements are going to be misleading or going to be wrong. But we have a requirement today to actually report these. We determined that there's significant deficiencies. We have to do it in a letter at the end of the audit to our client and to the board of directors. A material weakness, which is something clients absolutely hate. And one of the reasons they hate these letters is in a lot of loan requirements, banks or lenders require, I not only need to see your financial statements at the end of the year, I need to see your internal control. I want to see how good your record keeping is. I don't want to just know that the accountant signed off on the numbers. I want to see how good your record keeping is. So if you get to what's called a material weakness, it's a deficiency in internal control over financial reporting, such that there's a reasonable possibility that a material misstatement in the company's financial statements will not be prevented or detected on a timely basis. In other words, you've got such a hole in there in your internal control that you could have a material misstatement in the financials and we won't know. Okay? If you find something like this, you will find clients will fight you tooth and nail on putting that in a letter. Because oftentimes these letters are requested or required by some of their lenders. So this is a requirement is needed at the end of each job is to provide an internal control letter. Now if you find nothing, you say, I didn't find anything. Now, Section 404A came out as a part of Sarbanes-Oxley. Now we're talking about public companies. We've talked about this before. Management must issue a report on internal control, acknowledge their responsibility at the end of each fiscal year. They've got to put in a report along with their financial statements to the SEC under 404A and give evidence and support it why their internal controls are in place. This is all as a result of Enron and WorldCom, where it was determined the problem was poor internal controls, or lack of internal controls. So they're now required under this section of the Sarbanes-Oxley to report this. Okay? We as accountants, what is our requirement? When this law was put into effect, they put it into effect for public companies. Well, public companies in this country doesn't just count Bank of America and Apple and Google. There's a lot of small public companies. We're talking small companies that for whatever reason are public companies. Any stocks that trade over the counter, OTC stocks, there's a lot of little companies. The cost of these companies of doing, besides having an audit by a public company, which is required under all circumstances, if you're a public company, even if you're a public shell, you've got to have a financial statement. You've got to issue a financial statement. If you're public, you've got to issue an audited financial statement. They drew a line in the sand at $75 million. $75 million of market capitalization. Anybody not know what market capitalization means? If you don't be afraid to raise your hand. Do you know what market capitalization is? Market capitalization is a calculation, and we all do it all the time when we assess risk. You know what market capitalization is? You take the number of shares outstanding and multiply it by its price. That's what the market capitalization. How does the general public value a company? Well, you all look at it on a per share basis. But doesn't it matter how many shares are outstanding? So how do you figure out what the world has figured out what Apple is worth? Well, I'll tell you how. You can do it right now. Go onto your computer, take Apple's financial statement, figure out how many shares of stock are outstanding, and multiply it by today's price of Apple. And you'll get some ridiculous number in that case. That's what's called market capitalization. This is effectively, to be honest with you, when we look at companies for risk as accountants sometimes, whether or not we're willing to take them on as clients, because when you look at a company like that and you say, what is your downside risk? How much money could you lose? Well, you could lose as a client, an accountant, if you screwed up and a company went out of business. The market value of the shares before the screw up, which is now 0, times the number of shares. So if you bought a stock at 100 because you thought you got good financials, and today the company went bankrupt, you'd sue for your $100. That's what your loss was. So you look at the company and say, okay, how big a company is this? Not based on their revenues, not based on their profit, based on their market capitalization. Take a company like Tesla, okay? You look at Tesla, I don't think it has net worth. If it doesn't, the financials, there's not that much. They lose money. Market cap, big number. Okay? That's what your real risk is, market capitalization. So what they said, the SEC, or when the law was drafted, was, listen, you small companies, we don't want to really suck it to the worst. It's bad enough you got to pay for an SEC audit and 3 quarterly reviews. If your market capitalization is less than $75 million, your auditors do not have to do this internal control. You're not required to do it. You've got to certify it to your internal control, but the auditors don't have to get involved in it. So you don't need an integrated audit below a $75 million. Again, the calculation is based upon market capitalization. And I assume it's based upon it at the end of the year. I guess there's a date that we do this. Okay? What you worry about as an accountant, by the way, is internal control in small companies. Less employees, the more issues you have, okay? You can't segregate duties when you have one person doing all the accounting, okay? So there's a bunch of things that I'm not going to run through all these things that companies do in terms of trying to implement controls. What most of the time, the main control in a small company is management involvement, okay? One of the suggestions we always make to somebody in a small company, okay, you've got one person doing the general ledger, the checks, get the bank statement at home. And you open the bank statement and you look through the checks when you can, okay? You try to implement what you can, okay? But it becomes extremely difficult to implement a lot of what we call internal controls in a smaller company. So that's why sometimes in a small company, while we'll assess internal controls, we won't rely on them much for auditing because they don't really exist too much.